Good morning, everyone. We'll wait just a second to let everyone in. Okay, the numbers have stopped going up, so we'll go ahead and get started. Welcome to part 2 of alternatives for financing your early stage venture. Part 1 is on our website, and I will put the link into the chat. Please put all of your questions into the chat, and we will periodically stop so that those can be answered to the best of our ability. And our presenter today is Lou Farina, who is a business analyst with the Small Business Development Center, and he specializes in innovation. So Lou, I will let you take it away.
Well, thank you very much, Karen. Good morning, everybody, and welcome to part 2 of our webinar series here, alternatives for financing your early stage venture. As Karen said, we had part 1 last week, and we're going to talk about some other subjects here in part 2. But let me just kind of set the introduction, set the stage. Anybody who's on this call, if you're thinking about raising money, if you've been raising money, if you have raised money, you'll know that finding funding is a really tricky hurdle to overcome. It's very difficult. There are more options than people realize, I think. And where you should start and which ones are right for you. You can't do them all at once typically, is really kind of important thing to think about as you think about your funding strategy. And so we really kind of designed this webinar series, this two-part series, to talk about the various options and do kind of very much like a landscape overview at a very high level. So today, our part 2, we're going to talk about competitions. We're going to talk about SBIRs. We're going to talk about angel investors and founder funds, strategic investors, venture capital, venture debt, a little bit about corporate venture. So those are the topics for today. And as Karen said, this was part 1 of our recording. Part 1 is recorded. And the date, please, that's a typo. It was last week. This was from last year, but the QR code is correct. The link is correct. And we talked about self-funding. We talked about grants, friends and family, debt, crowdfunding, and some of the pros and cons of incubators and accelerators. So let me just flash. This is me. If you can see me, but this is who I am. Technically a job title is business analyst. We call ourselves really business advisors. I have a corporate background in corporate ventures. So a lot of activity around identifying strategic fits and acquisitions and mergers and different new ventures. I was an angel investor here in town, so I'm pretty well connected into that space. And I review SBIRs for the National Science Foundation. So I do a lot of SBIR type of work with clients looking to to obtain funding from different agencies. And they're very specialized. We'll talk about that. So this is me. And what I want to do, before I give you the SBDC services commercial, as Karen said, this is going to be, I updated this deck yesterday or last week, and there's a lot here. And I think we have 40 slides. That's a lot. Got an hour and a half allocated. We may have to go over a little bit, but it's going to be pretty quick pace. But I will try to stop after every section, take a question or two. We probably won't be able to go into a lot of depth. If you need more depth, come back to us for business register as a client. Could probably give you some more information. So SBDC, who are we? Why are you here? We're part of the America's SBDC network, which is a nationwide network of small business development centers. I'm in the Maricopa Center, so I typically serve Maricopa. From a geographical perspective, we've got 10 other centers here in the state. A lot of them in our rural communities. Some in Tucson, Prescott, They're all available as a resource. And if you went out of state, there are resources available for you also. And we're no fee, I think, as you probably already know, prepaid by your tax dollars, the SBA at the federal level, and then at the state level, the Maricopa Community College District funds the rest of our grants. So we're grant-based. We do a lot of different things. We've got counselors who we call them counselors. They're really advisors. We do a lot of SBA lender readiness, loan packaging. This is if if you're a more advanced business, you've got established cash flow, collateral. SBA loans are a great way to expand your capital to inject. We'll help you with financial reviews. We can do marketing assessments, buying, selling businesses, some manufacturing. There's something called technology commercialization, which is code for innovation. That's where I come in. We've got some specialists in international trade. We've got a sister organization that specializes in government contracting. So if you're looking specifically for government contracts, we usually refer you over to our Apex group, and we can help you with that. And at the bottom of the list is disaster loan assistance. We did a lot of that during the pandemic. We don't do much of that anymore, and I'm probably going to take it off my slide for the next iteration of this. So what do? We do counseling. Counseling is one-on-one business advising. You get assigned a business advisor, and that business advisor will work with you through the life of your business, no matter where you're starting from. So yeah, it's one of the unique things about the SBDC is, there's some continuity with your advisor. As long as your advisor's with the SBDC, you'll have a relationship. That advisor will get to know you, get to know your business, and you can do periodic check-ins and work with that advisor. We have training. This is training. Webinars are training. We do a host of webinars. You can check our calendar. No fee, of course. And then there's other resources like we have like live plans and business plan software. We've got iBiz World, market research. We've got Profit. I think we have Profit Soup, which is a financial analysis program. We got a lot of different things that we can provide to you at no fee, should you need them in the course of our advisement. So that's the SBDC. Let's move on. So I'm going to click through this. Let's get this all on the page here. So, and I showed this the last time, and I'll show it again. I like to think of at least equity investments, and we're going to talk a lot. Today's going to be more, for the most part, equity based, with the exception of competitions and SBIRs. And I just broke this up because I was trying to get a balance between the two sessions. So, but there's really a sequence. There's, first investment is always yourself. And, we assess what's the second investment. This is kind of a joke with investors. It's yourself, right? So you gotta have money into the business. No one's going to come into a business without you having invested yourself. And I don't mean time, I mean cash. We talked a lot about that the last time, and I won't cover it. But then there are things that are early stage, really early, like friends and family, crowdfunding, accelerators. There are some grants, and one of those grants are SBIRs. There's competitions, and we're going to talk about competitions, SBIRs. So that's the early stuff. After you get through that, you typically could be candidates to talk to an angel investor, maybe a founder's fund, maybe a strategic investor. Once you get through that, you're probably eligible to talk to corporate venture or maybe a VC firm, should you need to get this far. A lot of folks don't need to get this far. And then everybody's heard about IPO and private equity, and we're not going to talk about that today because that's typically much farther down the line, much bigger businesses. And if you can get yourself to VC, if you're a VC candidate, you're probably going to graduate here out of the SBDC program, and you'll have other help per se. So let's talk about competitions. And I just updated this. So, and I'm just going to give you a smattering of competitions here in the Valley. There's lots of competitions. They're virtual competitions, of course. We're going to talk about Venture Madness, which is coming up here in April, the AIC Challenge, the Flynn Foundation, ASU Venture Devils, and the CEI Big Pitch. So those are the 5 that I selected for us to talk about. And a competition typically is what it is competition. It could be pitch based, it could be application based, but usually there's an award, some kind of prize for this particular competition. And that's where, you can get some funding to help augment your business. I wouldn't say, we'll talk about some of the prize levels, but typically it's not enough to fund your business, but it may, maybe a nice chunk to get you maybe to a place where you couldn't have before. So important stuff. Here's Venture Madness. I don't know if anybody's heard of Venture Madness, but this has been going on a while here. It's brought to us by Invest Southwest and the Arizona Commerce Authority sponsors. And, it's a competition. It's a pitch competition. Matter of fact, yesterday or the day before, they just released the 16 folks that are going to pitch against each other. And they select through an application process. And there are some nominal cash awards for winning this, but the real, and I'm nominal meaning thousands, like a couple thousand, 2, 3, 4. I don't know what it is this year, but that's not what they advertise. What they advertise here is more your exposure, because it's really mostly angel investors and VC folks who attend this, and it's probably the most prominent pitch competition in the state that gets the most attention from outside investors. And we have people will come from, I've attended, you'll get folks coming in from Denver, you'll get folks from Salt Lake, from the coast, etc. There are different categories. They change every year, so they're selective based on their categories. And for finalists, they give you some mentoring. If finalists mean if you're selected in the top 16, they'll provide some mentoring for your pitch. There's an application window. It's usually from October, November timeframe. Again, you get some free pitch training prior to the application or during the application process. Finalists are announced. It was announced early February this year. In this conference this year is April 3rd through the 4th. I don't know off the top of my head where it is. So anyway, something to check out. It's actually, you can buy a ticket as general public, but they get to be expensive. I think, I'm not sure, $500 to $1,000 for a general public, but they really cater towards investors, and the rates are definitely lower for them. So let's talk about the AIC, Arizona Innovation Challenge, brought to you by the Arizona Commerce Authority, the ACA. And this is one, they bill it as one of the biggest state competitions in the country. So there's $150,000 cash and services offered as a prize for winning this. It's application driven. There's usually up to about 10 companies selected every year. And it's part of the commitment and the prize you get to go through their accelerator, ACA's Venture Ready Accelerator. The application windows in the late summer, early fall. There are virtual prep workshops available during that time. There are 3 judging rounds, so they go down to 25 semifinalists and 15 finalists, and then there's awards in November and December. The top 10, usually it's 10 or so that they give away. So usually it's technology driven. I'll say technology-based companies in here, but look at the criteria. Come see us in the early fall or the summer, get you prepped, and put an application in. So let's talk about the Flynn Foundation. I don't know who's heard of them, but if you're in the bioscience area, you probably have. They've got a bunch of programs, but one that I'd like to point out is the Bioscience Entrepreneurship Program. And if you win that competition, it's application driven with a pitch. It's $30,000 grant, and it's typically bioscience focused very broadly. You get some support. If you win, there's some exclusive events you're invited to, and you provided some connections within the bioscience ecosystem. So this has been going on a while, and it's very, very valuable. The application windows, December, January. There's an online info sessions. I think it just closed. I think January 29th, it just closed for the applications. The awards will be in late March, Typically, it's pre or early stage, early revenue stage companies. So they look for early companies, and they don't cater to research only projects. There has to be something. This is a commercialization focused, moving some science out of either the lab or the bench or the prototype into a business. And that's part of the criteria. So let's see, go forward, go backwards. ASU Venture Devils, anybody associated with ASU, and it's very broad. Anybody, a faculty, staff, community-based entrepreneurs with an affiliation. What does affiliation mean? I don't know if your kid went there, if you went there, if your spouse went there, it's pretty much open. So they say ASU affiliated, but it's pretty broad. They do a total of $500,000 for the year. They do it in 2 events per year, but then there are different categories. And so the typical, I mean, I've judged for this a couple times, and the awards for the first place in winners in the different categories range from $2,000 to $15,000, let's say. And then there are some second and third place prizes depending on the different groups that you're in. There are different categories for these groups, and it's short investor style pitches. The application window just rolls. It's like 5 times per year, but there's 2 events, fall and the spring. So, and you do get some access to mentors and to some space as part of the program. So it's a great program that ASU puts on. I'm going to go to the last one, which is the Big Pitch, and this is brought to you by the community college and our incubator here, CEI, in sponsorship with Wells Fargo on a private grant. So it's open. Now it's open to students that attend Maricopa Community College and ASU. And I just learned that was last year. I just learned this year, I think it's just open to community college students. So that kind of changes from year to year. There are several prizes up to $5,000. It's a pitch style competition. There are judges. And this one, you can attend this one at Venture Cafe, which is a Thursday entrepreneurial event every Thursday at PBC 850 downtown, and it will be April 25th, 2024. And I put a link down to that pitch competition. So if you're a community college student, right now, if you happen to be on, contact your entrepreneurial lead at your college and let them know you're interested. They may be running their own college pitches. Sometimes they take the winner of a college pitch and they will put them into the Big Pitch. So I think every college gets 1 nomination of the 10 different colleges. So anyway, very good. So the format of this webinar, at the end, I try to summarize, and I try to, there's good and bad with everything. And not like good or bad. It's just there's some pros and cons, right? You got to think just things you got to understand about what you're getting yourself into in these different areas. So for the competition, I mean, of course, we're going to get cash. We get, once you're starting to pitch in front of an audience, you're going to get exposure. You don't really know what that exposure is going to be. Exposure is a very general term for getting out in the public in front of people that a diverse group. You may not know who is in the audience, and there may be some valuable connections. Part of the competitions come with services and programs, right? So you get some services that you may not get. You may get some legal, you may get some marketing, and you may get some programmatics, right? You might get enrolled in an incubator or an accelerator type program as part of the winning the competition, as we saw with AIC. Takes time. Everything takes time, but it takes time commitment. The awards, as I said, are nominal. They're not huge, except, AIC is a pretty good chunk. Not always non-discretionary. I mean, not always discretionary. Some of the awards can be for specific things, so they can tell you what you can spend it on, what you can't, and some of them have reimbursement models too. So you got to be able to pay and then be able to collect. So there's some cash flow issues there. Programs I have it on both sides. Some people want the cash, they want the services. They don't want to be enrolled in a program. They don't have the time. Happens. And then, depending on who you're, if it's government agency, depending on who You may have some reporting requirements that you're beholden to that particular grantee or the person who gave you the award to provide, reports, and there's some oversight. So you may not like that. Okay, that was a mouthful. I'm going to take a breath. You got any questions, Karen?
Yes, does the ASU Venture Devils focus on technology only?
No, not technology only, but there are generally some technology categories, but there's some social responsibility, there's some sustainability. It changes every year, but no, not exclusive.
That's it.
Okay. All right. Let's go tee up the next one. We're going to talk about SBIRs and STTRs. I do a whole webinar on this with the ACA and our Apex group. This is a very complicated. I hate to discourage you, but it's a grant-based program that takes a lot of nuance, takes a lot of help to get through. But anyway, so I've got some expertise here, and I'm going to give you just the highlights of it. So the SBIR program, Small Business Innovation Research, is a competitive three-phase system, and there's different three phases. I'll tell you about the different phases. It was enacted in 82. So it's been around for a while, and it's really a mandate for federal agencies with more than $100 million in R&D. So it basically, I don't call it a set aside. It is, if you're a government agency, you're doing a lot of R&D work, there's a certain percentage, I think it's 3.2% of your budget has to go to small businesses, and the SBIR STTR program is that vehicle. So there are 11 agencies that do SBIRs. Here they are. The big ones are the Department of Defense, the National Science Foundation, and NIH, which would be the Department of Health and Human Services, DOE to a certain extent. Other ones do it a little bit smaller budgets, significantly smaller. We'll talk. I don't know if I have something about STTRs. They're a little bit different. I think only 5 of these agencies do STTRs. So subtlety, but we can talk more about that. So what are the benefits of this SBIR program, right? So it's a grant or a contract, I should say, depending on the agency, both grants and contracts, but it's non-dilutive. Okay, what does non-dilutive mean? Is, they're going to give you money, they're not taking any ownership position in your firm. So that's really good. We don't want owners, we don't want to give away our equity unless we have to. You get data rights and protection, it's yours for 20 years. So, and you're free to operate. Really important. Your government is giving you the money to do your research and bring this and commercialize a product. They're not taking any ownership, and they're not asking for any data rights. And then there are 5, what they call phase 3 awards. It's a 3-phase system. And you'll hear this term phase 3. Phase 3, all that means is the government, depending on the agency, I'm going to use the DoD as an example, can purchase your product at the end. So it turns into a procurement opportunity. And that would be a phase 3 award. So there's really no phase 3 money. The phase 3 comes out of the procurement budget for that particular agency. And I use DoD as an example of a phase 3, that does phase 3 procurements. NSF, NIH do not, for instance. So they phase 3 in their terms is commercialization. You're going out and selling it to the marketplace. So why do investors like SBIRs? And I like to put this slide in here because I look at it from an investor perspective. Again, it's early capital injection. SBIR money will go to technology, to risky technology where investors are not comfortable investing at the early stage. So that's important. It fills a nice niche. It's non-dilutive in capital. We talked about that. There's a level of validation if you get an SBIR, right? It goes through, and I'm a reviewer, so it goes through a vetting of science. It goes through, a vetting for commercialization, because there's a commercialization element to all of these. How are you going to make a business out of this? it de-risks the investment, right? So from an investor perspective, it's okay. Now I've moved this technology into a prototype, okay, that's good. Now, you know, there's less risk. The more money that goes in that's non-dilutive, by the time it gets to an investor, the less risk there is. So it de-risks it. But on the other hand, I'll tell you, I see this all the time. Simply receiving an SBIR grant doesn't mean the company is a good investment from an investor's perspective. Lots of SBIR grantees, don't necessarily turn into businesses or good businesses. That's just kind of the way it is. So these agencies do their due diligence. They're able to proceed you, but it doesn't. There's no guarantee per se that investors are going to follow on just because you got an SBIR. So here's the 3 phases. Phase 1 is a feasibility and we use proof of concept. So taking a technology, just proving it out, proving that this technology is feasible. The budget guide, 150, 250, 250 is actually up to like 275. It's usually 6 months on an SBIR, could be a little longer, a year on an STTR. The phase 2, we'd like to think of that as, going to a prototype. So there's difference between proof of concept and prototype, right? Proof of concept just means it works. Going to a prototype means I'm going to build like an early product. Now that gets significant. It's about $1 million, or up actually. If you're with NIH, and this usually takes over 2-year period. So it's a project over 2 years. Yeah, typically you have to have a phase 1 to get to phase 2, whether there are some direct to phase 2. Again, this is where the program gets a little complicated. But in general, it's sequential. And then 3 is commercialization. We talked about that. Commercialization phase 3 means to, let's say, to NSF means you're going to get subsequent investment, private funds to achieve commercialization. You're going to sell this to the marketplace. The DoD, right? There's possible procurement in the phase 3. So that's how it works. Very high level. Tell you what. So what do we like? What are the gotchas, right? So it is a nice chunk of cash. If you're a technology company in your early stage and you've got some really innovative technology, potential products, it's worth pursuing. It's risk seeking. It's innovative and risk seeking, and so they're looking for things that are really risky that otherwise might not be funded. It's non-dilutive. We talked about that. You get your IP rights, and again, it could be turned to a government contract. You could find a customer actually through this process. It's complex on the other side. It's very competitive. There are long timelines. I mean, 6 months, a year, 2 years, right? You add up the time it takes to do the proposal, the time that it takes to review it, the time to get awarded, the time to execute. If you're talking about startup time, right? I mean, in the startup space, this is like eons, right? Years. So you got to take that in consideration. It's not for existing products or existing work, right? It's not for something that's already been done, and it's also not for something that is easily done, straight engineering. And too much of a good thing is, you don't want to live off of SBIRs, STTRs. At some point, you need to commercialization. You might be, you might get these grants up front, but if you're unable to commercialize or, get private investment, then it's really, really difficult. It's not necessarily a good thing for you or for your business. Okay, so I'm going to talk about angels next, but any questions, Karen?
No questions.
No questions. Okay, that means I thoroughly confused everybody. Okay, but if you are interested in SBIRs, again, we're going to do another one, and there's actually some of my older ones are up on our website. You can see those, or you can come to us directly. We can work with you. So I don't know who's ever heard the term angel investor, but angel investors are a specific type of investor, and they're typically high net worth individuals who provide early stage capital for startup businesses, right? And who are they typically? You got professionals, you get lawyers, you get doctors, You may get some ex-corporate executives, you may get some successful entrepreneurs who have had an exit and want to put money back into the ecosystem. And usually, because angels typically invest in technology-based businesses very broadly, they have some kind of technology-based background. They're comfortable in the space. Could be anything. It could be a manufacturing person. It could be somebody who is in marketing, but for sales, but for a technology company. So they technically are comfortable. And the difference here is we've got a lot of high net worth individuals here in Arizona, and if they've been here a while, and they were they're fortunate enough to take advantage of land, real estate. They've accumulated significant assets. Those people typically don't like to invest in technology-based companies, right? They're just not comfortable in that space, and that's kind of a contrast. Just I throw it out as an example. Um, Angels are typically part of the local ecosystem, so they're part of this community. They know people who probably know you at some point, so that's good. Um, the Let's see. The SEC regulates angel investors to a certain extent. So you think about, if you're a private company and you're going out for investment, if you are only raising from accredited investors, this is a definition of an accredit, that the government puts out as high net worth, and they give you some parameters. You can get an exemption from the SEC as Reg D, they call it, for a less regulated investment. So they're not going to regulate you. But what they're saying is, we're not going to regulate you, but you're going to deal with people who understand the risk that they're taking, because the risk early on for these technology companies are huge. You may not realize it, but as an investor, it's really significant. And they don't want people getting into things that they don't necessarily understand. And there's an asymmetry of information. And how to extract that information is really a nuance. So anyway, that's who our angels are. They're semi-professional. You'll get angels and angel groups that they kind of almost evaluate you like a VC firm, so it's not necessarily a friends and family type of person, right? They're fairly sophisticated. They're looking for equity, typically, although there are some other vehicles, a safe or convertible note, but they're typically equity seeking, which means a priced round. They are risk seeking. So they want risk, but they want the return. And they're typically looking for a 10x return in 5 years. That's about the benchmark. And that's through an exit. And typically an exit, or some kind of other liquidity event that will return them the money, because they're always looking to get their money out. Angel investors aren't necessarily long-term investors. They want a liquidation event. Their check sizes, from an individual or group, 100,000 to 500,000, maybe higher. And that's typically what you'll see on the raise side. And the other thing they do is they bring some expertise. So, as part of the community, they may have some kind of expertise, and maybe it's medical devices, maybe it's I don't know, proton physics, I don't know, whatever it happens to be. But sometimes you get some expertise, domain, and then even non-domain experience, because some of the domain experts know their stuff, but maybe they just don't know enough about marketing. They're going to need some help. And so angels can also provide that to you. And then there's a difference, right? There are individual angels versus groups. And I'll talk about some of the groups here. But a lot of folks who start off in angel investing will join a group, and there's a lot of benefit. And I did when I first came, when I came out of the corporate gig, and I learned a lot from the other angels, because it's a very fertile environment. You have a very diverse group. It also provides deal flow, right? As an individual, I may not know how to evaluate or want to evaluate a lot of companies or know how to even find these companies. So this becomes a funnel if with for through these angel groups to provide an angel with deal flow or an individual member. The member, there are small angel groups of 10, there are big angel groups of 100, but there are groups. They have formal processes to apply to them, almost competition like to a certain extent, except there's no guaranteed prize at the end. But then on the other hand, you get folks who are experienced angels and they may be part of a group, they may not be, and they may be very comfortable approaching you or you approaching them as an individual and doing an individual investment. Right. So if you're going to do individuals, right, and there are individuals, you're going to take a lot of meetings to find somebody who's going to invest. We say 100, we laugh, we joke, 100 meetings or so. It's a lot of footwork, a lot of time on your part. If you go through an angel group, you may get, if you're selected, you may get to pitch in front of a constituency of 30 or 40 or 50 angels at once. And that's really valuable. So that's the difference. And one of the things I wanted to address here is in angel groups, how are decisions made? So there's no typically, for the most part, without absolutes, there's really no fund in an angel group. It is an aggregation of individuals. So there's no group consensus mechanism. Okay. Which means that, and I have a picture here of this is okay, I heard the presentation. I want to do due diligence. Who's interested in investing? And you raise your hand or you fill out a card. And that interest, the amount of people in that group who have the interest and are willing to pledge a certain amount of money is the raise that you get from the group. So that's important. So angels there's no managing partner that typically invests on behalf of the angels. So there are some funds that are out there, but for the most part they're not. So that's important. And the other thing that's important is now I got all these people, like a 10, 12 investors from this group. I don't really want them all on my cap table, honestly. If you move forward, it gets complicated when you have that many people for different reasons. But what they'll typically do is form an SPC, which is a single purpose corporation for the investment. And so it'll be a single entity on your cap table. And that's very appealing as you move forward. So they know how to do that. And it's just something for you to know. And, the last thing I put here is herd dynamics, right? So, there are thought leaders in different areas. And I may look to my left, and if Joe, who I know is the expert in the subject, is going to invest, I might say, I'm not really comfortable knowing, but I'm comfortable. I know Joe. So I'm gonna go into this round with him or her. So that's kind of how it works. So anyway. I wanted to talk a little bit about founders funds in slash VC. And this is fairly new to the Arizona landscape. I'm new, I mean, last 5 years or so. And what this is you get successful founders who have exited, and now they want to become active investors and put their wealth and experience back into this ecosystem. And they'll set up funds. Their contribution will help, their money, their expertise will help fuel innovation for the next wave of companies. And we're starting to see this. There's typically a lead, it may be an individual, they may bring in a couple limited partners, investor, so there may be a couple of them in this group. And they're managed funds, right? They are, and the decision is really, it comes down to that individual or her limited partners that are in this fund. So it's important. We've got them. I'll talk about who they are a little bit. So take advantage of. But let's just talk about in general, angels and maybe founders funds. What are they looking for? What's their appetite? How do you appeal to them? So really, and the top of the list isn't necessarily the idea or the technology. It's usually the management team. So, it's the jockey, not the horse, kind of the saying. And so they'll evaluate you as a management team. Um, and or, even if you're an individual or two, who are your board of advisors? Who are you surrounding yourself with to help you out with this? Is it scalable? Right? How capital efficient is it? How capital intensive is it to get scalability? I mean, right? We know that SaaS platforms or SaaS software is the most scalable thing ever invented in the investment world, right? So there's a lot of money on software. A lot of money goes into software type of firms because they're very scalable. But also, there's lots of software apps and whatnot to pick from, so they're very competitive. Is it a market size? Is it a big market size? What's the opportunity? What's that growth rate of that market? Is it a big market that's growing? Is it a small market that's growing? Is it a small market that's not growing? This is important to know, what your market niche is, how big it is, and what are the trends, what it's growing. Do you have any early traction? If you're a SaaS platform, I will say that most investors won't talk to you unless you have traction. Um, but if you're not, if you've got some early customer commitments, etc., a lot of this is all pre-revenue or really close to revenue, or maybe even trajectory into revenue. You got to make sure once you are in revenue, and if you don't have the right trajectory, it could be a negative from an investor. It's like, okay, what's going on? They're in revenue, but I don't see sales increasing. Why not? And how attractive are they? And a lot of times it's, well, we just need more money for marketing. And a lot of times it's not necessarily the fact. Risk mitigation. Do you know your risks? Do you know what are your risks? How are you plan on mitigate them? Where do you need help? This is risky stuff. If you can't identify your risks, you're either ignorant, maybe that's a kind of a harsh word, but or you're just maybe you're hiding something. You think you're hiding something. Good investors, good angel investors will be able to drill into your company and uncover your risks. Do you have financial forecasts? Well, what's your current burn rate? What's your current financial position? What's your financial forecast look like? The forecasts aren't as important long term. You got to have them. Not a lot of people put a lot of weight in them, especially long term. But your first 12 or 18 months, you should be a line of sight. If there's any revenue or any customer opportunities, you should be able to identify those very, very specifically. And then, at the bottom here, I have exit plan, and it should be at the top or one of the top things, right? If you can't tell an angel or a founder how they're going to get their money out, what your exit plan is to liquidate, then you're going to have a hard time continuing any kind of conversation. So you got to think about your exit plan. Who are the companies? Is it going to be some kind of acquisition? If it is, who are those companies? What are there similar companies that have been sold? What is the, what's the valuation? What's the multiple, etc. So doing some comps. So, okay, here's some of the local groups. Karen, am I okay? Okay, just checking. You've got ATI located here in the Valley. You got Canyon Angels associated with Grand Canyon University, also here in the Valley. You got Desert Angels. They're typically they're based in Tucson. You have a group out of ASU called InvestU, again for ASU affiliated ventures here in the Valley, but really kind of statewide. You've got Golden Seeds, and Golden Seeds is a national angel group with a chapter here in Arizona, really catering towards female-owned ventures with female-owned investors. So these are kind of some of the local groups. There are other groups that are out of state. There are groups that are virtual. I can't list all of them here, but I just want to give you an idea who the local ones are. Here's some of the founders funds. So there's Romy Dillon, Sonoran Founders Fund. There's AZ Disruptors, Hamid Shoei. There's Jack Selby, AZVC. Phoenix Ventures, Greg Scoresby, fairly new one. These are all investor or entrepreneurs who have had successful exit or exits. And then there's Andy Lombard. He runs AZ Venture Development, and I kind of group them in here because they're more like VC fund. It's a fund, but it's really SSCBI Treasury money that's vested alongside these founders or angel funds. So they all have websites and process, and they'll tell you how to engage with him. Okay, let me tell you what I like and what things you really kind of got to be careful of. So angels can have significant funding. A lot of money can be raised by angels. Again, angels, they're local. They've got some knowledge. They've got experience. They are, they can be, I don't know, right? They can be difficult, but they also can be really valuable if you pick the right ones or if they pick you. Increased odds of success. If you get angel funding, it's good credibility, especially if you've got to go to another angel fund or if you've got to go to a VC at some point. It validates. There's some networking. There's connections because right, angel groups. If it's an angel group, then you've got all this. You got a built-in network, right? They know people who know people. Not a ton of paperwork, honestly. I mean, you got to go through due diligence, which just means you got to give them everything they ask for as far as paper goes. But as far as the investment goes, it's not. They'll probably make it convert to a corporation. But other than that, it's not a ton of paperwork. And we are starting to see, seen angel groups expand outside of their local areas. So traditionally, it's been a local phenomenon, but you've got the pandemic kind of forced us all to be virtual for a while, and then all of a sudden teams were virtual, and then all of a sudden investment was like crossing local boundaries. So there's that dynamic, and that's continued. On the other side, angels are never the first money in. You haven't put any money in, you don't have anybody else any money in. Could be difficult to get an angel. They're hard to find. The angel groups will hang a shingle, but individuals don't necessarily want to be found. They'll find you, depending on who they are. You have dilution, right? You're going to give away an equity stake in your company, and with that could become some control. You could be having to giving up a board seat, which could be good. It could be bad though. It may not be what you want. Sometimes, right, they kind of step over the line. You get some role clarity issues. You do have very high expectations for returns. Again, this 10x in 5 years. And the process can be slow and relatively slow, not slow, not SBIR slow, but it takes time to find them. It takes time to pitch them. It takes time to go through the screening process. There's due diligence. So, I'd say an angel group from the time you apply to the time you're funded, 4 months, 5 months, 6 months. So if you're at the point where, hey, Lou, as your advisor, I'm out of money. I need money today or tomorrow. I need to go raise from angels. I usually tell folks no one's going to write you a check in a week, So anyway, okay. Knock that one off. So Karen, any questions?
Yes, if I can take off mute, and sorry to interrupt earlier. So there is a question: is there funding for new companies that are not in the science and technology arena? It seems very startup innovation driven for funding.
And we're going to actually, interesting. It's a good segue because we're going to talk about strategic investors next as kind of not necessarily tech focused. But it seems biased, but the reason tech is really has high value, and that's why these investors are attracted towards the high scalability and valuation of these tech companies because they're taking risk in liquidation event. So let's talk next about strategic investors, which are kind of, I think, where you're going. Is that it, Karen? Assuming that's it. Okay. All right. So good question. Strategic investors. So these are investors that are maybe more interested in the long-term growth of your business. Okay. They're not looking necessarily for a liquidity event. They're not necessarily looking, to get their money out per se, but the investment, could include cash, and sometimes it does, but it also, there's always some kind of synergistic relationship with the existing business. Maybe there's some sharing of manpower, maybe there's co-marketing, maybe there's joint development, maybe there's some intellectual property. There's usually something that brings these company, small businesses, and investor together because of synergistic um, forces. So um, the difference being, and let's see, the difference being here, angel investor, let's just compare them, right? We talked about these tech investors, angel investors, semi-professional, exits focused, liquidation, domain expertise. A strategic investor, again, maybe there's a mutually beneficial relationship. Let's look at long-term growth. Maybe there's a share of the profits that can be worked out. And maybe there's a shared like a business domain. So these are the different type of investor. Where do you find them? And so they exist. I mean, they exist. Can I tell you from like I know the angel group, the tech stuff? No, I can't. They don't necessarily form groups per se, and but they could be typically within your span of reach of your business. So think about your suppliers. Think about your customers. Customers are absolutely delighted with your business, right? I have a friend, he's in the entertainment business, um, out in LA. He likes his pizza place. He invested, in the pizza place, right? He's a customer, right? This guy walks in, buys pizza once in a while. Any related business, even out of somebody you might think is your competitor, maybe not, there, you got to explore those opportunities. And even service providers, people that you're contracting with. I mean, service providers typically have a pretty good view of your business. And if they can see some synergies between the service they're providing and your business, there may be some opportunity for investment. So again, it's your span, it's your span of influence. It's people who know you, it's people who know your business, it's people who know your products. Another example is restaurants, right? Lots of restaurant startups, really hard to get a bank to finance a restaurant business. Who invests in restaurants? Other restaurateurs, people who have been successful in the restaurant industry and or people who know the food industry and or the beverage industry, et cetera. So this is kind of the flavor of strategic investors. Um, the good and the bad, right? You get some funding, increased access, you get some potentially some synergy. Could be some shared assets. Again, there could be some control and role clarity. Now you're bringing in kind of a partner per se, who's going to have some say in an agreement. There may be some misalignment. You got to be careful. You may have some loss of flexibility. So again, you just don't want to, do a strategic or a synergistic deal without really being clear about what that is with this other individual or an other entity. Because if you're not clear, and it could really wind up, in a bad situation. And there are lawyers that specialize in partnership agreements that can textualize your thoughts into a contract that kind of works. I would certainly advocate for some kind of partnership agreement should you get into a strategic relationship with another company and or individual. Like on the angel side, there's nothing more than, I'm going to give you my money. You're going to give me a certain percentage of your company. I may take a board seat. I may not. Um, you know, Go make some money so we can liquidate, right? It's actually simpler. Karen?
No questions.
No question. All right, I'm really making good time here, so I thought this would take longer. So, okay, let's start to talk about I think left we have venture capital and I think corporate venture. Okay. So a lot of folks come to me, come to us, come to the equity market and saying, I need to talk to a venture capitalist. I need investment in my company. And most of the time, I don't know, they don't necessarily understand the sequence and or the structure of the industry and what that really means to talk to somebody in venture capital. So venture capital are employees, their management, fiduciaries, capital firms that invest other people's money into companies. They hold a fund. So there is a fund. Um, not much different than maybe if you had a mutual fund, right? You have investors that invest in that mutual fund, and you have people who are managing that fund. Um, they're typically uh, large institutions. The investors are that put small percentage of their total funds into high risk investments. So if you're a pension fund or maybe an insurance fund and you need diversification, um, you will put, and diversification means you need different types of investments. There's always a slice of risk that you want to put in there. And, depending on who you are, how big that slice is, even individuals kind of think like this. So these funds may allocate some of their risk capital toward to a venture capital fund to take on that risk and the return. Um, let's see. So they they are later in the game. They avoid really early stage companies when there's like uncertainty in the market or there's uncertainty in the technology. They're more apt to play when there's in later stages, when there's competitive shakeouts or some consolidations that are inevitable. Um, that's when you kind of see venture capital come in, and they're typically looking for the home run. They're usually looking for the next billion-dollar business, and they have the same kind of mentality as an angel investor group in that they're risk seeking, but they want to diversify their investments. They're looking for the big. So what I didn't mention in the angel side is what drives angel returns or what drives venture capital returns is the home run, is the one big upside. So that 10x in their portfolio, right? They're looking for the big upside to help mitigate all the other nine. And maybe if you had 10 different companies, nine that aren't going to perform, they're looking for the one. So venture capital typically looking for the billion-dollar business. Now, I will tell you, some of them have seed funds that will invest earlier, but that's usually reserved for repeat um, um, uh, companies or founders that have exited and provided returns and capital. They may seed those their next venture. Again, it's really hard um, to really get a venture capital firm to provide seed capital to an unknown company. It usually starts grassroots up through the angel kind of networks and whatnot. Um, let's see. So they're check sizes. So let's talk about them versus angels. And so we talked about angel check sizes, maybe 100,000 to 500,000, maybe a little bit higher, 750 or so. VCs, I mean, on the lowest end is 2 million, more like 5, but they're really like looking for chunks for 20, 30, 40 million. And you'll hear like Series A, Series B, Series C, they typically get bigger as they go. But here's a number, and this is some older data, but it kind of holds the number of companies funded per year. So in any given year, there's 75,000 companies that are funded by angels, of course, at lower check sizes. There's maybe 3,750 in this particular year that were funded by VCs. So VCs, much higher check sizes, much lower volume of investments, right? The work to do a $2 million deal is the same work to do a $50 million deal. So that's why you don't really see them going, down towards the low side. There's some economies, they've got limited bandwidth, they've got limited resources. Now, some of the some of the founder funds who are funds and they act kind of like VC, I would say, because they're fund driven, will, they like they'll skew down here towards this $2 million, 1 million to $3 million range. So okay. The VCs have a high degree of specialization, where an angel group may be very broad and diverse in their in their constituency. VCs typically specialize, and they concentrate on two or three different sectors, and they're very overt about it. And it's not like they try to hide it because they want to attract those firms. And I'm gonna, I gave you some examples here. Kleiner Perkins, pretty well known. They like hard tech, enterprise software, healthcare. And why do they like it? Well, they've invested in it before, of course, but they've got expertise, not only investment expertise. These VCs will also bring on their own talent and or consultants, and they typically have connections in certain areas to provide that talent to help them evaluate, and or if you take VC funding, you may have some help running your company. You may not be running your company, depending on how the deal is structured. So that was a little diversion. So Accel Partners, they like consumer security marketplaces. They like SaaS. Blumberg Capital likes consumer internet. They like social media. They like private networks. Let's see, Alloy Ventures, life sciences, information technology, clean tech. Let's see. I'm sorry. I just pulled these just to give you an example, right? These aren't all the VC firms, although there aren't a ton. And they're not necessarily the most prominent per se, but just to give you an idea of the kind of different areas that they focus in. Okay, so what was the next slide here? Okay, what do they want? What's their appetite, right? So I threw some data. The deal size averages were like for Series A were $5 million plus, with the average of about $27 million. And we talked about that a little bit, right? The deal size. And it'd be nice to have someone invest $27 million in your company, right? Let's say you thought you were worth this investment, your valuation was right. So, the question you ask yourself is, I had $27 million today, how would I spend it? What would I do with it? And if you can't answer that in like 30 seconds, you don't need $27 million, right? So that's kind of one of the litmus tests. Do you know what you need your money for? Even with angels, you got to know what you need your money for. But venture capital, it'd be very specific. Their growth stage, they like a competitive advantage. They like a nice clean cap table. So if you've got a bunch of people on your cap table, friends and family, blah, 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 you might have to clean that up. So they may try to knock people off your cap table to clean it up, because they don't want, when they make decisions, they don't want to have to work with lots of other people on those decisions. A lot of them like to have an angel endorsement. So angels will typically hand up to a VC, or a VC will ask, have you had any angel investment in your area? And they'll know, typically they know the angel groups in the different towns or the different angels. You got to have a reasonable cash burn rate. Cash burn means, what are you committed to on a monthly basis? So you don't want to be exorbitant burning cash. Deals are sourced, a lot of it's through personal networks and referrals. So is it a good old boy, good old girls kind of network? Well, kind of, yeah. It's usually you're introduced to a VC by somebody who knows them and thinks that you are a candidate. And I talked about the reserve seed funds. So they're usually reserved again for repeat founders. So venture debt. And I put this slide in, was it last year? And I just wanted to talk about it really quickly because of what went on with Silicon Valley Bank when that kind of all melted down. So when you hear the term venture debt, it's an interesting term. Typically, they will invest alongside a VC equity round, and they'll provide maybe 25, 30% of that equity round. And it's a complementary method of equity financing. So most most startups in the early stage really don't have assets to be used as collateral or necessarily even the cash flow to take on this debt, but the venture debt lenders, are compensated with warrants on the company's common equity. So there's an equity convert. So that's their collateral typically. Um, it's a debt solution. It is expected to be repaid, and it's less dilutive than pure equity than warrants. And typically, these guys don't get a board seat per se, and it could be used broadly anywhere in a business. So that's when you hear that term venture debt. Again, just very high level. It's usually they usually alongside a venture capital round. You don't see venture debt going in without a VC round being established. And the VC companies will usually bring in the venture debt companies typically on their deals. So venture capital, right? Lots of money, significant funding. Got to need it. Got to need that money. There's business expertise. Again, like angels, they've got specific expertise and maybe even more specific expertise. I had a venture. I ran into a venture capital fund manager at one point, and we talked about things. And he said, "Oh, you kind of understand this business." And he said, "Yeah." He said, "I got some, I've got some, consulting opportunities for our portfolio funds. Have you ever been the CEO of a major of a Fortune 500 company?" And I just kind of laughed and said, "No." So, but that's kind of expertise they're bringing in. Connections, all right. They know once you're in there, they can connect you with who you need to be connected to, additional resources, and very much they're about accelerated growth, right? They're looking at their money going in because they want you to be the next billion-dollar business, and they're very focused on accelerated growth. Again, downside dilution, ownership, control, okay, all the things that come along with equity. However, this is kind of equity on steroids because you're going to get a lot more attention. You're going to have a lot more control issues when you do take VC money. Difficult to access. We talked about that, the network, and most companies aren't ready for VC or don't really need it. And so if you're spending your time chasing VC money, and you don't need it, or you're not ready, or you're not in the right spot, then you're wasting just a lot of valuable entrepreneurial time. Time is really important too, because that's the only thing. All this money stuff we can make. The time we actually never can get that back. So, and also there's clients that I work with that said, "Yeah, well, I got a meeting with a VC." Well, the way that usually works, if you get a meeting, that's great. It's usually a junior associate who's doing the screening. And that's good to get a meeting, but that's usually the entree. So that person is not a limited partner, not a managing partner. It's typically this junior person, and they hire fresh outs out of the top business schools in the country. That's typically who these analysts are, and to do the all the due diligence and kind of manage their pipeline that gets then handed to a partner at some point for evaluation. So getting a meeting with the VC is great. It doesn't necessarily mean you're into the decision maker, not whatsoever. Okay, Karen,
No questions.
no questions. All right. All right. Let's see. All right. I think this is the last one is corporate venture. So what is corporate venture? And you may have heard, if you've been in town, maybe you've heard of Intel Ventures, right? Or if you've been around technology, Qualcomm Ventures. Like, what are these groups? What do they do? And they they invest corporate funds into existing startup companies. And again, I have experience here, direct experience. They're funding, there's a lot of money being funded through corporations into startups. $79 billion across almost 2,000 deals in the first half of 2021. Okay, old data, but it holds lots of money, billions and billions of dollars. Um, So most companies are developing capabilities on their own, with regard to their business. They're investing in technology, they're investing in products. A portion of these companies' profits or margin, let's say margin, will go into R&D expenses, right? If you look at any of these large companies, look at their R&D percentage line, you'll see about 20% of their money, of their sales, let's say, go into R&D. So, but sometimes they're slow and they're expensive. And small startup companies are innovative, they're nimble, and they can do things quicker. And so that there's an impetus for corporate ventures not only to invest in themselves, but to invest in other companies that may be able to do things quicker, faster, better than they can, and they can do it on an investment and an acquisition basis. But on the other hand, it also it can serve as intelligence gathering. So if I'm doing my own thing internally, and you'll never know what I'm doing internally because I don't have to publicly disclose that if I'm a publicly traded company. But I may go out to the market and talk about investing in companies that I think might be competitive at some point, small companies, and I might engage them in discussions, and I might do it just for the purpose, or maybe not solely for the purpose, but I may be able to gather a lot of intelligence, right? If I come to you as a big venture company, as a big venture arm of a big company, and I start talking to you about investing, and I'm asking you to tell me about what you're doing and how you're doing it. Okay, so there's no obligation for me to share, for me as the big company to share what I'm doing. This is not a joint necessarily synergistic per se activity. So intelligence gathering is part of the practice. Here are, and I took the time at one point to just to list the ones that hang a shingle out as a venture arm. So we got some of the big companies here, Verizon, Qualcomm I mentioned before, GE, BMW, let's see, you got Citi, Samsung, etc. And what I will say is that um, all corporations, all big corporations do, participate in corporate ventures. Not all of them will actually carve out a division that, and they will fund that division per se for ventures. So there may be a big company that you don't see here that does venture work, but they do it from within inside the business units, the operating units. They don't necessarily hang a shingle out. And so there is activity going on. You can't approach almost any. There is, if you've got a target of talking to a big company, it's going to take some work. Would they hang a shingle out as a venture arm or not? There is somebody in that company responsible, or a group responsible for assessing external investment opportunities, acquisition opportunities in that product line or technology line. So corporate ventures, what are their objectives? So we talked a little bit about they can acquire things that people can do faster and maybe better than they can. They could be strategic or financial, right? And financially driven corporate ventures are really achieved through a lot like a venture capital firm or an angel. They want an exit. It's financially driven, and that's less the case typically, because some of them feel the need to diversify their revenue stream and start to invest in other areas and make money there. However, the vast majority of corporate ventures is strategically driven. So they're looking to do deals with startups, with new technology, new markets, acquisition targets, and accessing new resources through strategy. So it could be that we talked about that strategic investor at maybe more for Main Street businesses, maybe for restaurants. Well, same kind of thought, um, with a venture, a corporate venture firm who's strategically driven, which are most of them. There may be a product or a piece of what they need in their solution for a customer that they don't have or are slow. And by itself, it may be valuable, but to them, it could be really valuable um, in terms of maybe even just timing, being able to acquire it and integrate it into their solution. So, a lot of them are looking for things that, one and one make four instead of one and one make two. And I did a lot of this. It's a lot of strategic acquisition, strategic planning for different elements of the corporation. And the corporations, most of them have good engineering forces, lots of good technology, and they could pretty much do anything they want. They've got priorities. There's always struggle for resources, for priorities, and so again, corporate ventures is a way to kind of it kind of almost competes to a certain extent with the internal development capabilities of these corporations, which is a good thing, can be a good thing. So I'll stop there. Let's just talk about uh, the good and the bad. So corporate ventures can come with an investment. It can come with some domain expertise, some talent that come along with these big corporations. They're full of talent. It could add some credibility if you've got, a big corporate venture firm invested in your startup. They're patient. They have longer term time horizons. If they're not financially driven, which most of them aren't. I mean, they are in the end, but not as just an investment vehicle. They're more patient. Most of the time they don't want to control your business. They'll take less than 20%. There's fewer control provisions. So you don't have to worry about that. They may let you operate much more freely than maybe a venture capital firm would typically, only because they're trying to run their business, right? You may get a board seat, you may not, but you have to think about it when you take money of somebody who's got a strategic relationship with you, or there's some kind of synergy that makes sense. Now, what does that signal to everybody else in the marketplace, right? So they could put in the terms, and you got to watch the terms. And again, you're going to need a lawyer, good lawyer to help you with this. They may have they may want the first right of refusal to acquire your company. So now let's say this thing goes gangbusters and you want to sell it to somebody else. Well, if you've taken some corporate venture money, it may be in your contract that you can't, that they have the first right of refusal. They could potentially block acquisition offers or financing rounds that don't align with their strategic interests. Now they've got their strategic interests in mind. And so as you go to the capital markets, if you try to do some other things, they could, constrain you a bit. It could be a turnoff to potential customers or business partners who now view themselves as a competitor because you're aligned with this particular large company. So you got to be careful. And I did talk about intelligence gathering, right? Sometimes it's a fishing expedition, and you got to be really careful about, wanting to engage, but giving out too much information without the proper protections, of course. But even then, so you got to be really careful. So, Karen, I think I'm done.
No questions.
Oh boy. Okay. All right. With that, we talked about a little bit about counseling. We call it counseling, advising. If you want to talk to a counselor, come see us. Here's the link. What we sit down, we're by appointment only. So can't just drop by the office. We do an initial session. We do more about identifying your business goals, understanding who you are. And then we do these follow-on sessions, which means we have subsequent meetings with you, tracking your business goals and helping you through decision points. So you can meet regularly with a counselor. I think Karen's got a program now where we're asking kind of at least our new business ventures to do a little bit of work, do a little bit of putting some, attending a session with Karen and putting some stuff to paper before they meet with a counselor. It's actually in everybody's best interest. Your initial session will be much more productive. If you do that, you'll learn some stuff also by going through Karen's session. So anyway, let's see. Questions again? No questions.
No questions.
Okay. All right.
Oh, someone said, can I see the first couple of slides? I can, Lou, is it okay if we
Yeah.
send the slide deck out?
Yeah, I have no problem with that.
Okay.
Yeah.
So I will be sending out this slide deck after the class as soon as I receive it. It will also be on our website, which is the same website that you go to request counseling. It's maricopa-sbdc.com. And if you look under training, there is a whole section of recorded webinars. So our first session is already on there. This session will be on there as well.
So just a couple upcoming this year, I've got a couple sessions that I'm going to do on SBIRs, a deeper dive, and on angel investing, a much deeper dive, a whole session. And Karen and I even talked about prior to this meeting, maybe even do it in person. So we'll see. Well, thank you, everybody. Thank you, Karen, and everybody have a great day.
Bye. Thank you.